Let's get one thing straight. Your pension and your fund manager isn't failing because they're incompetent and they're rubbish. It's because they have several embedded points of failure. One is they're usually given funds to focus on a geography, like they're only allowed to pick UK stocks or Japanese ones, and I'll explain why that's a problem in a second, principally because it's a narrow gene pool they're picking from, and you might think you can solve that by buying lots of different funds from different regions. Actually, then what you're doing is you're spreading your money very thin, because each of those funds will have very little money in each stock, because you'll have bought so many funds. You'll have put very little money in each fund, therefore trickling down you'll have very little money in each of the stocks that underlie it. So one reason, geographic limitations. Secondly, they're often limited by the style they're allowed to adopt by the fund management company. So they might only be growth. So it might be now UK, narrow gene pool, UK growth. Or you might say, well, that's simple, I'll just make it global growth. Fine, you think you've got a solution, there's more problems. And if you only look at one style, that means they're necessarily ignoring various incredibly important pieces of information, such as valuation, such as cash flow, such as momentum, all of which we know are important factors for future stock price movements. So why do fund managers do this? Well, it's not the manager, it's the firm. The firm wants to sell lots of products. So it says this is a fax machine, this is a printer, this is a copier. Very few, if any, actually I don't know of any, will just say, well, actually this is all in one, we've only got one fund. That's all you invest in. The hedge fund industry does that time and again, but the retail investment industry doesn't. So, got a problem with geography, got a problem with style. The other problem that you've got is theme. Very often it's become very popular, particularly with Cathy Wood, is to have themes, buzzword themes. I think they Google these things and they say, ooh, crypto, ooh, AI, ooh, cyber. Now again, you might think, well, that's sensible, like they're specialists in that theme, I will buy that fund and I'll buy that one and put it all together. Again, you've got the problem of you had to put a little bit of money in each one, and each one of those funds will have 50 to 100 stocks. So theme is a limiting factor. You're picking from a very narrow gene pool once again, as opposed to which are the best companies producing the best returns. Now, if you look at somebody like Warren Buffett, actually he isn't thematic. He doesn't talk about themes. He's got Coca-Cola, Wrigley's, now you might as well, he bought those years ago, yeah, American Express, Apple, bottom up. It's what's called a bottom up approach rather than thematic. In fact, he's so anti-top down, he pretty much only puts his money in the United States. If he was properly top down, he might say, well, I'll put a bit in, I don't know, Europe, a bit in Southeast Asia, and so on and so forth. So bottom up is a better approach. Now, the other problem which sets up fund managers for failure in the fund management industry, and it's not, as I say, negligence or that they're rubbish, is aside from geography, style, theme, three things, is the quantum of money that they have, because whoever's promoting them, at Bailey Gifford or whoever they are, they've got billions under management. Even the most unknown fund, and I was just looking at one managed by actually a fellow Patel, I won't mention which fund it is, he's got $1 billion under management. No, I've never even heard of the guy. Okay, now if that was a hedge fund, in the hedge fund industry, that would be sort of just slightly getting onto the radar. That would be the kind of guy you don't kick sand in the face of on a beach. You'd be thinking, oh, billion. In the retail industry, there's just so much capital that actually, billion, never even heard of the guy. Okay, now because they've got so much capital, they can't actually put that money in any company they want or divide it into the best companies, because some of them they'd end up taking over unless they put tiny amounts in. So what do? They spread the money in small amounts into a lot of companies. But the problem with that is if they do find a good company, then they put so little money in it, the needle barely budges. So again, you've got another failing, that they've got too much capital, which shouldn't be your problem, but it becomes your problem. Okay, so that's another problem with the industry. Now, the final issue, there's others, the final issue is when the market is falling and they can see it's falling, they've got a conflict of interest with you, as does the IFA. They're not going to say to you, move into cash. Now, some IFAs claim, oh yeah, we do, we advise on other things, not just investing. We'll give tax advice, so you should still not criticize us, and we'll tell the client when they should stop paying us fees and just hold cash and still pay us on their cash, whereas the bank pays you for holding your cash. They want to be paid for, they want you to pay them. 2022 is a good example. It is critically important, if you look at an old chart of Meta, it is critically important that in years like 2022 you have the ability to sidestep the market and hold cash. I mean, I could not find companies which I thought were worth investing in 2022. I'm sorry, I couldn't, because the downward momentum was dragging everything down. Costco and Microsoft were falling, so better to have cash. My point being, this notion that there's some magical fairy tale companies you can pull out when the market's falling, and the market when it's falling is correlated to the downside. The 18 odd books you can't quite see over my shoulder that I've written and discussed this, and the evidence for it and the data behind it underlines it. You're not going to be able to pick a company out of nowhere, which is what the fund managers think they can do and the IFAs think they can do if that company doesn't exist. So what they say instead is, oh, don't worry, we put a little bit of money in a whole load of companies to diversify rather than going into cash. Well, it doesn't, because they're correlated to the downside. So putting a little bit of money in a load of companies which are all going to fall still means you fall. It's thinking like that which led to the financial crisis and pretty much every crisis since. The lack of understanding that fat tail or extreme events occur more frequently than we think, and things are more correlated than we think. That's it. That's every financial crisis described just like that. Extreme events happen more often than we think, and things are more correlated to each other than we think. That's it. That's finance in a nutshell, which is not the finance they'll teach you in most of the schools. People get Nobel Prizes for showing that kind of stuff. Don't believe me? Look at William Sharpe, look at Richard Thaler, Daniel Kahneman, Eugene Fama. So those are the reasons why the fund managers are dragging things down. There's a massive conflict of interest, and their hands are tied in many ways. Of course, some of them might just be rubbish, but that's a separate issue. On top of that, you've got that, which is why I've been encouraging people to learn for themselves. If they learn just even to ask the right questions, that's the starting point. And even better, if they learn how to do it themselves, have that portfolio of maybe 20 companies which have been selected out of 10,000, judged upon their value, their growth, their cash flow, their dividend yields, and so on. I think they'll be in a far better place than they find themselves most of the time as things stand at the moment. Thank you.